This has been a story that I think has been pretty much under the radar for many out there. But why have gold prices been on what has been really a steady uptrend pretty much the entire year?
I think we just basically had a perfect storm of positive gold drivers. You mentioned a few of them already, Dom, but I think adding to this, we're also seeing the the developments we're seeing in U.S. bond yields, because what is the alternative to gold? That's obviously you're looking for yields, you're looking for dividends. Right now, the real yield in U.S. bonds are negative, and they're continuing to move deeper into negative territory. And I think we lost a little bit focus on this recently because the nominal yield, the 10-year bond yield, or T-note yield, has been very steady. It's basically boxed in a relatively tight range. But over the past couple of weeks, break-evens have moved higher. So in reflection of higher inflation expectation going forward, and we're seeing real yields move lower at the same time. That is the underlying demand that's driving that. But I think also we're seeing the move in these fantastic moves in stock markets right now. I think as we continue to move into the stratosphere there, we are seeing some increased demand for insurance coming into the market. And bonds right now doesn't really provide much insurance, and that basically means gold, and now to a certain extent also silver is attracting some demand.
What exactly then? I mean, the traditional view here is, yes, safe haven demand, right? People go there because they're worried about things. They go into a bunker eventually down the line. They want their canned goods. They want their gold coins, that sort of thing. And also the inflation expectations thing. None of those are likely scenarios that are playing out, yet gold demand just continues to rise. What exactly is it about this environment that has people worried about? Is inflation really a driver? We haven't really seen it anywhere else yet, except in certain food items and in asset prices, specifically stocks.
I think there is a belief that the more impact we're seeing from central banks, the bigger the risk that we may have done too much when we eventually come out of this pandemic and we start to see growth recover. How central banks are going to rein back and some of all the spending they've done in that period. So I think it is the inflationary worries that's still out there. But then also investors love momentum, and gold has had quite a strong run now since June last year. And right now, my biggest worry right now is really the fact that we're all talking about it's moving higher, and that's obviously always getting me nervous. But that's kept me nervous in the stock markets now for the past month. So you can't really use that argument right now. But overall, I think it is basically just the worry about debasement of the global markets from all this liquidity that we're seeing from central banks, the potential inflationary pressure returning, and also the dollar, which has been it's stuck here, but it has showing a little bit of signs of weakness recently, and that may also add some support.
Ole, you're not the only person who's kind of worried about asset inflation right now. I mean, everybody we talk to is somewhat cautious about these right now. I'm curious, though, because when we talk about physical commodity, especially precious metals, oftentimes we talk about the financial assets, right? The futures markets tied to them, ETFs, and also the physical aspect of gold, owning the bullion or coins. What's really driving the action these days? Is it speculation by people buying financial assets or actually buying physical gold?
I think it's physical gold, but then you can also ETFs, which some of them are physical deliverables, some are not. So let's call them paper gold for good measure. So paper gold demand primarily has been, I would say, the driver. There are discussions and different regions got some pretty high premiums if you want to buy spot gold, but I think that's our physical gold. Some of that probably is still just some of the waves we've seen after all the problems we had back in March and April with transportation and so on. But the ETF is really where the demand is, and I think ETF investors they tend to be more sticky. They are more long-term focused because ETFs is not a leveraged product. So you're in one for one, and so that's where the demand has been. If you look at the leverage traders, the hedge fund, watch the cut report very intensely on a weekly basis, and we've seen quite a big drop in net longs there. It actually dropped to a one-year low just 3 weeks ago. It's only now for the past few weeks we've seen hedge funds start to accumulate again, but their position is way below the record highs we saw in recent past. So they still got plenty of space to accumulate. There might be some speculation that because of the breakdown we had in the transatlantic spread between the futures in New York and spot in London, we may have seen some of these funds move their futures positions or more strategic long-term positions into the ETF markets in order to avoid the volatility we had in the spread between gold and spot. But overall, investment demand is strong in ETFs, and is only now starting to pick up in futures.